India's growth story seems to be clouded by the latest figures. With the India-US trade deal making headlines, running the sentiments high, the latest numbers have pictured a different story. Imports have surged, exports are on hold. The trade deficit has widened. So what is widening India's trade deficit? What can be its impact on the Indian economy? Let's take a look at it in this video. First, let's take a look at the latest numbers. In the latest trade figures released for January 2026, India's merchandise trade deficit widened to $34.7 billion in January 2026. Now that is the widest gap so far in this fiscal year. If we compare the numbers on an year-on-year basis, the trade deficit stood at $25.4 billion in the same month last year. It reflects a clear imbalance between what India buys and what it sells. The reason? While exports in goods barely edged up around 0.6% to about $36.56 billion, imports surged nearly 19% to over $71 billion. For the unversed, let's also understand what a trade deficit is and how it works. A trade deficit happens when the value of imports is more than the value of exports. For example, if country A imports $500 billion in goods but only exports $300 billion, it has a $200 billion trade deficit. In simple terms, a trade deficit occurs when a country buys more goods from other nations than it sells to them. Now to the key question. Why has India's trade deficit widened in January? The biggest contributor to this surge was precious metals, especially gold and silver, where import values skyrocketed. Gold inflows jumped more than 3.5 times compared with last January, pushing up all the overall import bill. Behind the scenes, some export markets saw pressures too. Shipments to the United States fell sharply in January amid elevated tariffs, even as overall export numbers stayed slightly positive, hinting at diversification into other markets. Despite the widening deficit, the services sector offers a silver lining with strong year-on-year growth, helping cushion the impact of merchandise trade imbalance. A widening trade gap can exert pressure on foreign exchange reserves and the currency. Heavy reliance on gold imports, particularly driven by high global prices, continues to shape India's external account. This can downward pressure on the rupee, increase inflation, and widen the current account deficit. The United States remains India's top export destination, whereas China stays the top source of imports, the data showed. In the fiscal year so far, India shipped goods worth $72.46 billion to the US, higher by 6% as compared to $68.46 billion in the year-ago period. January 2026 also marked the final month impacted by around 50% US tariff on Indian exports. So as the 50% US tariff ends, will it translate to less trade deficit for India? What do you think? Let us know in the comments section below.